Most people think debt is a problem, but what if debt is actually one of the reasons modern economies exist? Without debt, the world around us would look very different. Most people think of debt as a heavy weight. It can be a source of stress for families. It can be a burden for nations. We are often told to avoid it. But this is only one side of the story. Debt is also a powerful tool. It is a hidden engine that has helped build the modern world we live in today. It helps people buy homes and get an education. It helps businesses create jobs and invent new products. It allows governments to construct the roads, bridges, schools. It will explain what it is, why it is used, how it shapes our lives, for better and for worse. Debt is not a new invention. Its history is as old as civilization itself. Its role has grown enormously over the last few centuries. Without it, our economies would be vastly different. The pace of progress would be much slower. Opportunities for ordinary people would be far fewer. At its core, debt is a very simple concept. It is a promise. One person or group receives something of value now, usually money. In return, they make a formal promise to give it back later. This repayment almost always includes an extra amount, which is called interest. The interest is the cost of borrowing the money. It is the fee paid for being able to use the money today instead of having to wait until you have saved it. This fundamental exchange is the basis for all forms of debt, from a small loan between friends to the massive borrowing of a national government. It is a contract built on trust and a belief in the future. The most common form for individuals is personal debt. Credit card balances for daily purchases, auto loans for buying a car, personal loans for an unexpected expense like a home repair. A very specific and large type of personal debt is a mortgage. This is a long-term loan used to buy a house. Mortgages are usually paid back over many decades. This allows families to own a home long before they could save the full price in cash. These forms of debt help people manage their lives and acquire major assets. Education is another primary reason people take on debt. A college degree or a specialized technical skill can significantly increase a person's earning potential. But the cost of higher education can be substantial. Student loans allow individuals to invest in themselves. They borrow money to pay for tuition and living expenses. They bet that skills and knowledge will lead to better jobs and higher income. Education debt is an investment in human capital. The spirit of entrepreneurship also relies on debt. Imagine someone with a great idea for a new bakery. Imagine a small tech firm. Imagine a local repair shop. They have skill and vision, but lack funds to rent space, buy equipment, and cover initial costs. A small business loan can provide the capital to turn ideas into functioning businesses. This borrowing is a risk. The business might fail, but it is also a source of economic vitality. For a business, debt is like fuel for an engine. It provides the power needed for rapid acceleration and growth. A successful company might want to expand by opening new stores in different cities. Instead of waiting years to save up the profits needed for this expansion, it can take out a loan to fund the growth immediately. This allows the company to capture new markets, increase its sales, become more competitive. Debt enables a business to act on opportunities quickly. If a plan is solid and demand is strong, borrowing money can be the fastest path to becoming a bigger and more profitable enterprise. Companies also use debt to invest in their own productive capacity. It could mean purchasing a fleet of new delivery trucks, or it could mean investing heavily in research and development. These kinds of investments are expensive, but they are crucial for long-term success. By borrowing, a company can make these large-scale improvements now, which can lead to lower costs, better products, higher profits. Nearly every business experiences cycles of high and low sales. During a slow period, a company might not have enough incoming cash to cover its fixed costs, such as rent and employee salaries. Governments, like individuals and businesses, borrow for reasons that are fundamental to their function and purpose. One of the primary reasons is to finance large-scale public investments. Think of the essential infrastructure that underpins a modern economy: highways, bridges, airports, railways, power grids. These projects are incredibly expensive and take many years to complete. It would be nearly impossible to pay for them using only 1 year's tax revenue. By issuing bonds, a form of debt, governments can raise the large sums of money needed to build these assets now and spread the cost over many generations of citizens who will benefit from them. Governments also borrow to respond to major crises. When a country is faced with a war, a catastrophic natural disaster, or a public health emergency, like a pandemic, unexpected and massive expenses arise. At the same time, the crisis often causes the economy to shrink, reducing tax revenues. In these moments, borrowing is essential. It allows the government to fund emergency response efforts, provide aid to affected citizens, and maintain essential public services. This ability to tap into credit markets gives a nation the financial flexibility to weather profound shocks and begin the process of recovery. Another important use of government debt is to manage the economy during an economic slowdown or recession, when businesses are cutting back and unemployment is rising. A government might choose stimulus spending, borrowing to create jobs and support demand. But there is a crucial distinction between productive and excessive debt. If a government's debt grows much faster than its economy, it can become unsustainable, leading to higher interest rates, reduced investor confidence, and tough choices. Imagine a world where borrowing and lending were rare or even non-existent. What would that world look like? The first and most noticeable effect would be on homeownership. Without mortgages, the only way to buy a home would be to save up the entire purchase price in cash. Most people would rent for their entire lives or wait until late in life to buy. Sprawling suburbs would likely not exist. Society would divide more sharply between property owners and permanent renters. Business growth would slow to the pace of reinvested profits. New firm formation would be constrained. Innovation would slow to a crawl. Governments would fund everything from roads and schools to hospitals from a single year's taxes, making big projects rare and upgrades delayed for decades. Crisis response would be severely hampered. In short, slower growth, less opportunity, reduced dynamism. It might be more stable in some respects, but also poorer, with fewer paths to invest in the future before the cash is in hand. Life would proceed at the pace of saving, not ambition. The modern world's rapid change and prosperity are, in part, products of leverage. Imagine that quieter pace. While debt can be a powerful engine for growth, it also carries significant risk. When used excessively or irresponsibly, it can lead to financial instability and crisis. This happens when too many borrowers, individuals, companies, even governments, take on more debt than they can realistically repay. It may begin as a private problem between borrower and lender, but it can spread through the entire financial system. Lenders that are not repaid take losses and pull back on credit. This credit crunch starves the economy of oxygen. The global financial crisis of 2008 is a stark example. Before the crisis, U.S. mortgage lending standards became very loose. Risky mortgages were packaged into complex securities and sold worldwide. When homeowners defaulted, values collapsed. Major banks faced insolvency. Credit froze. Businesses could not finance operations. Consumers pulled back. Millions lost jobs, homes, and savings. A deep global recession followed. Debt crises have recurred for centuries. If investors doubt a government's ability to repay, interest rates rise and default can follow, with severe hardship, banking collapse, and long-term loss of market access. The leverage that amplifies gains can amplify losses. So we have to be careful. As we look to the future, we see that the global sea of debt is vaster than ever before. Since the 2008 financial crisis, total debt across governments, corporations, and households has climbed to record levels. Governments, corporations, households. A long period of extremely low interest rates made borrowing very cheap. Governments stimulated, companies bought back stock, individuals purchased homes. These promises now shape the years ahead. Debt costs are highly sensitive to interest rates. Low rates make big debts manageable. But as rates rise to combat inflation, servicing costs jump for governments, companies, and families. Sustainability hinges on debt growing more slowly than the economy. The path forward is balance, prudent policy, transparent public finance, productive investment, and better financial education. That's the challenge ahead. Debt is neither inherently good nor inherently bad. It is a powerful financial tool, much like fire. Used with care and respect, it can provide warmth, light, energy, enabling us to achieve things that would otherwise be impossible. It allows families to own homes, businesses to innovate and create jobs, governments to build the foundations of a prosperous society. But handled recklessly, if it grows out of control, it can become a destructive force, as crises throughout history have shown. The story of the modern world is inextricably linked to the story of debt. Progress and vulnerability intertwined. The key is balance. Use debt to finance real value, maintain strong oversight, and remember past lessons so we don't repeat them. Debt is a promise, and the health of our economy depends on those promises being kept. Debt can create opportunity, growth, and prosperity. But when it grows too fast, it can also create risk. Thanks for watching Wallet Economics. Subscribe to understand the system.